Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode we're going to talk about OSFI, the Office of the Superintendent of Financial Institutions. What are they proposing to change when it comes to mortgage underwriting guidelines, and what does it mean for you as a first-time home buyer or an existing homeowner? How will it change the market? Stay tuned, you don't want to miss it. Earlier this week, we heard from Peter Rutledge and OSFI, the Office of the Superintendent of Financial Institutions, and they have been in the news over the past few weeks, not only with the stress test rule, but now currently with the implementation or the conversation of putting in more restrictions when it comes to mortgage underwriting guidelines, policies and procedures for the major institutions or the major banks. And in this episode, I want to take an opportunity to look at OSFI, what they've done, who they are, and more importantly, what they're concerned with. But also we want to take an opportunity to look at some of the changes that they could be proposing moving forward into 2023, as well as how this could impact first-time home buyers, existing homeowners, and more importantly, what it could mean for the housing market as a whole. So for many Canadians, they may recall back in 2016, under the B20 guidelines, OSFI introduced what's called the MQR, or the Mortgage Qualifying Rate, which was originally designed for insured mortgages, those with less than 20% down. But quickly, on January 1st of 2018, it was implemented across the board for any mortgage that was originated, any refinance or restructuring, and we have now basically come to terms with having a qualifying rate here in Canada. Although that number has changed over the past few years, OSFI is responsible for maintaining that rate based on the current economic situation and what is happening in the financial markets. So back in December of 2022, we heard from Peter Rutledge and his indication and concern with the financial markets as lenders were faced with the possibility of higher defaults on mortgages, loans, credit cards, and so on. And in order to ensure that Canadians don't over-leverage themselves and that the financial markets remain stable, he decided to leave it unchanged. Now, although many have pushed back against OSFI and required them or asked them to change that qualifying rate, I do believe it was a vital tool from its inception to ensure the stability of the financial system in Canada, as well as create some stability in the housing market. And although during the times when interest rates were much lower and the thought of having an interest rate of 5.25% was hypothetical, we are now here where interest rates are in and around that actual rate. Now, a lot of times people will misconstrue OSFI and their purpose. The purpose of OSFI is not to implement or impact any changes in the housing market. What their goal is to ensure that all their 400 regulated banks and pension funds that they regulate remain financially liquid and stable. That is their goal. They don't want to influence the housing market. Although I believe that's a byproduct of every change that they make, they are not concerned with the demand and the supply of housing and what Canadians are doing. They just want to make sure that the banks that they regulate operate within a very strict guideline. And that was part of the qualifying rate. Every lender had to adhere to that actual qualifying rate. And actually that helped a lot of Canadians, or maybe didn't help a lot of Canadians, achieve the goal of home ownership and keep them in check. So I believe, as I mentioned, the qualifying rate did protect a lot of Canadians from themselves. So now looking forward into 2023, why is this so important? Well, let's take a second and look back at what is actually industry standard versus what OSFI is trying to do. So for insured mortgages in Canada, those are the mortgages with less than 20% down. Depending on your credit score, you have to follow the servicing ratio set out by the insurer. You have to fit a specific ratio of 39 to 44%, 39% being gross debt servicing ratio and 44% total debt servicing ratio at a credit score of 680. If you are below 680, then that is significantly reduced to 35 GDS and 40 TDS. So GDS stands for gross debt servicing ratio, which is basically your gross income, how much of that money is going towards your principal, interest, and heating of that actual mortgage. The total debt servicing is your gross income, so the payment, interest, principal, and heating, plus any other debts that you have, such as a car payment, a credit card, a line of credit, anything that reports to the credit bureau. And as I mentioned, depending on that credit score, those numbers can range. Now, this is obviously implemented by the insurer, and lenders have to follow that guideline. But let's say you're a client putting in over 20%. Well, at that particular point in time, the lender has a little bit more of room to play when it comes to those ratios. They could be slightly over, they could be significantly over, and depending on other criteria like your credit, your income, your assets, a lot of things taken into consideration, that lender can decide on whether or not they will allow you to push those servicing ratios higher. Now, it's important to understand that major banks will do that, as well as other equity lenders across the board. Now, the goal of OSFI is to try and scale that back in to ensure that the lenders can operate these types of situations with a very strict adherence, meaning that they want to bring those ratios back to 39 or 44 and not leave much play for clients to move above and beyond that. So some of the things that they're proposing are obviously the restrictions on mortgage size and debt load. They're also trying to ensure that debt servicing coverage doesn't exceed 39% or 44% TDS. And they also might be talking a little bit about the possibility of changing the stress test rule or increasing it depending on the type of mortgage that you're taking. Now, it's important to understand, as I mentioned, these are conversations. They're sitting with the lenders. They're talking about opportunities to ensure protection of the financial institution, but also ensuring that the lenders are still profitable and are able to lend to Canadians. And some of the conversations that we're hearing in the industry is maybe that they'll change the servicing ratios, maybe they'll change the stress test rule depending on the size of the mortgage, maybe depending on the term of the mortgage. So let's say you're taking a 1-year term versus a 5-year term, what that stress test rule could be, because obviously the exposure might be there. There could be a conversation about amortization for specific situations, as I mentioned, and as we saw over the previous few months, where lenders were being creative when it came to helping or potentially helping their clients when they found themselves in a situation where they weren't able to either increase their payments or having to face higher amortizations. Obviously, this is a major concern not only for OSFI, but for the lenders themselves in order to ensure their stability and their ability to be there for Canadians tomorrow. So obviously, we know from what is happening and what Peter Rutledge is saying that there are going to be some further restrictions to the actual underwriting guidelines and will be put into place. Instead of being industry standard, it should be actually industry policy. And that is the major change that they're looking at doing, going from what the lenders do and how they can play around with those ratios or regarding how that income is looked at to making it a very strict and more adherable guideline. Now, obviously with these changes, what does it mean for first-time home buyers? Well, if you're purchasing a home with less than 20% down, I believe, and as I said, I don't think there's going to be many changes when it comes to those ratios, but only time will tell. But being an insured purchaser is probably one of the most stringent right now in the marketplace. There's no room for movement. If you're not putting 20%, you have to have a specific guideline set out by the insurer. And obviously that is something that's industry norm across the board from all bank perspective, insurer perspective, and obviously qualification perspective. But if you're putting more than 20% down, obviously if they start to restructure those servicing ratios, the GDS and TDS as we talked about, and not allowing them to exceed 39 or 44, that could definitely have a severe impact on people that are buying and refinancing. And it could take anywhere from 5 to 10% of the buyers out of the market. I mean, that's just a rough number, but it could take a significant amount out because many Canadians just don't fit that guideline. They might be a little bit over, they might be a little bit under, but generally with higher qualifying rates, they're usually being pushed higher. Now, obviously, that's going to have a significant impact on the housing market because the moment you take buyers out or challenge their qualifications in a market that's already seeing higher elevated interest rates, even with home prices coming down, the qualifications are obviously going to be much more stringent. And I believe in the short run, this will definitely have some significant impacts on the housing market. But one thing I do want to point out is that if these regulatory changes come into play, what does it do to the non-regulated industry? What does it do for private mortgages? What does it mean for, let's say, equity or B banks who have extended ratios, who operate in that space? Obviously, only time will tell. Will that push more clients who don't fit the A banking model, the conventional banking model, which is your top 6 in mono banks or your broker-friendly banks, into other alternative lending spaces? And if so, will that basically push Canadians into more precarious situations when they're finding themselves not being able to fit the conventional model. This is something that these conversations are going to be ongoing. It is something that we're going to cover on this channel. So we'll leave the video here. We hope that you got some information out of this video, and I hope that everyone enjoyed the video. If you have, and you know someone that could benefit from this video, please feel free to share it. And don't forget to subscribe to the channel, hit that notification bell, and do us a favor, hit that like button and leave us a comment on your thoughts on what you think about OSFI and the potential changes coming down the pipeline. But until next week, thanks for watching, thanks for clicking, have a great weekend.